I was always interested in how do you make money. I would like sell candy to my brothers after Halloween because I realized that Kit Kats became more valuable once they used all theirs up, so I could get 2 gummies for my Kit Kat. But I realized when I was looking at who are the richest people in the world, they were all either business owners or investors. And I was thinking, I'm only 12 years old, I can't start a business. Maybe I'll look at what the investors are doing.
I have a similar story too, because I used to sell Pokemon cards in middle school.
Hey, Mark Cuban's big into Pokemon cards.
Yeah, that's funny. Now it's time is a flat circle. It all comes back around. At NerdWallet, we're all about side hustles for extra income and short-term goals. But working hard isn't usually what makes people quote unquote rich. Making your money work hard for you is. Before we get into that, I need to remind you that I'm not a financial advisor, and the creators I talk to in this video aren't either. This is not personalized financial advice, but we hope it gives you a high-level picture of how investing long-term generates wealth.
First things first, never take a recommendation from some random person on the internet. Don't just do what I say because I say to do so. What I would recommend, though, is get educated on what is actually the most likely to make you money in the long term.
Being able to have an emergency fund and paying off credit card debt before even investing, I feel like those are 2 priorities that you must have done.
Assuming we have that financial foundation in place, the first place I'm going to look is my workplace retirement account. So whether that's a 401k, 403b, whatever you have through your workplace, a lot of times companies will incentivize you with what's called an employee match.
So you've got your debt in check, you've got your emergency savings squared away, and you've unlocked free money for retirement with that employer match. So what do you do next? Well, that's for you to decide. It's the reason I reached out to Karan, Jacob, and Danny. They all approach investing through a slightly different lens than I do. No answer is right or wrong, it's just what works for them. One thing we all agreed on, though, is putting some money in the market, using a thoughtful and well-researched approach, of course, protects your finances from inflation.
Right now, the yields for high-yield savings accounts, you can get 4.5%, 5.5%, which is good, but that's not going to last forever. And over time, that's not historically done 8, 9, 10% like the S&P 500. So if you're just saving your money, unless there's a reason for it, like a down payment for a future house that you're going to make a rental, or some sort of other reason that you're investing your money, like a business, then I would really recommend just simply into an index fund instead of putting it underneath your bed where you're just burning cash to inflation and it's just eating your money away.
We've seen 8% inflation in recent years. That's a guaranteed loss of 8% of your money every single year. And if you wait for 20 years, you might lose 50% of your money just sitting in your bank account. I remember hearing a story a few years ago of someone who had heard their great-great-grandfather had a bunch of Civil War money kind of stashed away somewhere, and it was a fortune worth of money. They end up finding the money, and it's like $2,000, which was a fortune during the Civil War, but it's not worth that much anymore today.
And so it's really important to make sure that you buying assets, buying investments that go up in value faster than the rate of inflation. Otherwise, you're literally losing the value of your money.
Now is the part where we talk about risk. Yes, investing is risky. If not done properly, you can lose money, and even if you do it right, you may lose some too. But that's why it's important to think about it long term. There are proven investment products and strategies that have historically increased in value over time. While that doesn't guarantee future growth, data-backed options like funds tracking the S&P 500 are often a safer bet. Ultimately, how you invest money is personal. It's unique to your risk tolerance and investment timeline. You'll notice in my conversations, they all take slightly different approaches to building their own portfolios.
I'll get 2 of the best ones from each market sector. And then I keep that to a minimum of my portfolio, maybe 10, 15, 20% of my entire portfolio. And then for the majority, I go with the index funds. And like I said, that could be S&P, small cap, mid cap. You could get a total stock market fund that covers all 3 in one. You could get a growth fund, and you could add more exposure like real estate, or even a small amount of international if you want.
I have a pretty simple approach. I'm young. I'm 38. Well, maybe not that young. My kids wouldn't say I'm young. But I've pretty much got a majority of my investments in a total stock market index fund through Vanguard.
So the data shows that most investors will make the most money by just passively investing in an ETF, which is where I actually put around 75% of my money. I invest passively into a broad market ETF in my company-funded retirement account. I think that is what most people should do, up to about 15% of their income. After that, if you have more money left over, I think that's where you can get a little bit more into active investing. And it doesn't have to be stocks. It could be real estate investing. It could be starting a business. It could be looking into stocks in an industry that you know a lot about. I think the key here is you want to kind of take what I call a barbell strategy, which comes from I think the book is Anti-Fragile by Nassim Taleb. The idea is you pair a very risky strategy with a very conservative strategy. So you have your passive kind of baseline strategy of just investing into the overall market, and then you pair that with a higher risk strategy, which in my case is investing in kind of these high-flying growth stocks, which have a lot of potential to rise quickly, but also more potential to drop. And you don't want that to be your whole portfolio because you'll just have a very, very stressful life, which is why you pair it with that more conservative ETF strategy.
No matter which strategy you choose for yourself, one thing to consider are fees. Fees cut into your growth potential by pulling money off the table. The main fee to know is your expense ratio. A mutual fund with an expense ratio of 0.5% or less is a decent deal. The best 401k plans offer mutual funds that charge less than 0.2%. The lowest fee options are usually index funds and ETFs. Reducing fees is important for long-term growth, so don't forget this step. Here at NerdWallet, we have an investment calculator which can be found in the link in the description below so you can see how much your money can potentially grow to over time. Now, if you've made it this far into the video and aren't already investing, here are some tips to get started.
If I was just starting investing today, I would say as far away as possible from day trading because 99% of day traders lose money. Not a great way to start out. If I was just getting started, what I would focus on is first educate yourself on what fundamental investing is. This is the style of investing used by the greats like Peter Lynch and Warren Buffett, people who have outperformed the stock market over a 40-year career, not just for 1 or 2 years in their parents' basement. The idea here is to just understand what makes a company great, and then will that company be worth more in the future than it is today? It really is that simple. And by keeping it really simple and just focusing on finding great companies, I think it's way easier to get started, and it's just a proven better approach over the long term.
I like the idea of saving on taxes because that could really eat a chunk of your investment returns if you're paying, 12, 15, 20% on taxes or more. For me, I personally like the Roth IRA account. So the Roth IRA, though it doesn't save you on taxes now, what I like about it is its flexibility. You can access the money you put in at any time. So say you put in $7,000, which is the contribution limit for 2024. If a really bad emergency happened and you drained all your cash, you could pull that $7,000 out, penalty and tax free if you needed to. Not the growth on that account, but just that initial principal investment. So it's almost a backup emergency fund.
So I would recommend if anyone can take advantage of an HSA, health savings account, first go there, then 401k, because both of these accounts, you could be getting money from your employer. Currently, I'm self-employed, but I do take advantage of the Roth IRA. I think that is one that is my first go-to.
And if you've already done all that and are ready to play in that 15% active investing bucket Karan from FinTech mentioned earlier, we recommend dollar cost averaging, which reduces risk by averaging a stock's buying or selling price over a long time period at set intervals. But the other important piece is research.
Number one, it's do you understand the business behind the specific company? So if you're investing in a stock, you don't just want to kind of watch the stock price daily. You want to understand what is the business itself doing. Number two, you want to get smart on the company. So I would recommend reading an earnings transcript or listening to an earnings call. You should know who the CEO is. You should know what their thoughts are. Number three, I would be able to explain why I'm buying or holding the stock in 2 to 3 sentences or less. If you can't explain it simply, you probably don't know it well enough. And then number four, do you know what would cause you to sell the stock? As long as you know, one, why you bought it, and then two, what would cause you to sell ahead of time, it kind of protects you from emotionally selling if it drops or, selling out if it goes up a little bit because you have a baseline established ahead of time for what the investing decision is that you're going to make.
As you're doing your research, keep the objective simple. You're looking for companies you want to become a shareholder in. Don't let media hype or mountains of data overwhelm you. Like any important financial decision, take your time and make sure you understand the risks involved.
Even if it does feel risky, you can find a strategy that minimizes the risk for you. If you educate yourself in the space, there are ways that you can take it from a negative where you're losing money every year to where you're compounding a little bit of money over time to actually building real wealth for retirement. I don't know anybody who's become wealthy or even retired just based on their income. You need to have some kind of compounding vehicle operating under the surface to grow that wealth for you.
Long-term investing involves making informed decisions that lock your money away to grow and build wealth. In a lot of ways, it's not too different from those Pokemon cards I used to sell. You don't need to catch them all. You're picking your team, you're holding on to the true gems, and adjusting the players as situations change, hoping that someday good fortune comes your way. If you got value from this video and it was helpful to you, send it to a friend or family member or share it on social media. As always, subscribe, hit the bell notification, and check out all the resources on nerdwallet.com.